If I said I hated index funds, would you still like me? Don't worry, you don't need to answer that question. I still like index funds.
They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
When Jack Bogle gave birth to index funds in 1975, I doubt he ever thought that that little finance baby of his would go on to rule the world.
Incredibly popular area.
The growth in index funds since their inception has been monumental, especially in the last 20 years. Low fees and an even lower amount of effort, and an undeniable track record when it comes to comparisons with the actively managed side of the market, which, to be frank, is laughable. 92 to 95% of actively managed funds, basically funds where there's someone picking for you and they charge you a fee for the privilege, failed to beat their passive index benchmarks over a 15-year period. Ouch. So in 2019, the inevitable happens, and passive investing strategies that use index funds and ETFs overtake actively managed funds as the dominant force in world finance. And that's because the whole world is full of individuals telling you the benefits of investing in index funds long term, myself included. If you don't know what the benefits are, watch this video here. So I thought today it would be fun. Index investing and fun. So I thought today it would be interesting. Nope. So I thought today we'd look at a couple of the potential negatives, because it's always good to know both sides of the argument. I'm coming at this from the perspective of an investor who invests in index funds, but also buys individual companies. I believe people can follow multiple strategies if they want, as long as they are investing long term, consistently, and maybe picking up a few cheeky deals when they see them. So all of the arguments against index fund investing that go along the lines of it's limited, it lacks any form of control from the actual investor, and stops you from being able to jump on opportunities that may or may not arise in the future, I think only really apply if all you do is invest in index funds. I don't. But even if you do, to be honest, a lot of those are the benefits. A lot of people want that choice taken away from them. I personally also want that set it and forget it long-term play that requires little effort and has historically done very well. So if I don't become James Dean of the investing scene, it's okay. I have my index funds. So it doesn't matter that I didn't hit the big time investing in individual companies, no matter how surprising it is to me that those moody tips that I get off my boy Tremaine didn't quite pay off.
Damo, what's good? Look, I've got this rock solid tip for you, but you've got to jump on it right now. Trust me, it's going off!
Thanks, T. So let's leave out any negatives that can be fixed with a more varied investment approach and look solely at arguments for why we shouldn't invest in index funds at all. There are two negative arguments that I identified when doing this research that I really think have legs when it comes to critiquing index funds. They are by no means every critique out there. So if you have any insight, opinions, or just comments or thoughts on what I discussed today, please drop it down below in the comments. I will reply. It makes these comments a valuable resource for others and also helps me be a better creator. The first is the concept that the tail starts to wag the dog.
What?
Most index funds allocate the money that they collect based on market capitalization, or basically how big each business is within the index. So for example, if you buy an S&P 500 index fund, more of your money each month is going to go into Apple than it would the 500 business in that index. In the same way, if you buy Vanguard's FTSE All-World Index Fund, VWRL, then more of your money each month is going to be placed in American stocks than it would in other geographical locations. The concern here is that index funds don't come in and look and value a business to see if it's fairly priced, like an active fund manager would. What they do instead is they just skim their data off the top. Which is the most expensive? Okay, buy more of that. In the past, when index funds made up a small proportion of the buying activity within the stock market, that was okay. But the argument is now that index funds have become so big that rather than just skimming the prices, they're setting the prices. And the prices they're setting might be wrong. Apple is the biggest, so Apple shares get bought more, a lot more, so Apple's share price rises as a result. It makes a lot of sense really. I've also heard it called forced indexing. There's actually an investment strategy called front running that goes a little like this. You buy a company before it becomes part of an index like the S&P 500. So when all the index funds that track that index have to buy shares in it, the price will increase. An incredible piece of work by Kevin Liu at Seeking Alpha, which is linked below, showed how while the price does rise on the day of launch, in most cases it then sinks back down again after, suggesting that the price increase is not a result of indexes, more people betting on the impact of the indexes. I do also think that the influence of index funds can be overstated quite a lot. Yes, they have had a monumental rise. I think 1/5 of all stock market activity in America is now as a result of index funds, which is a lot. but you've still got the majority of the market there that is either actively managed funds, individual investors, or other institutions that are contributing value data into the markets. The second negative I found quite compelling was that the provider of these indexes are becoming too powerful, and that their passive, lazy approach will infect the corporate world and ultimately stifle competition, which is the heart of capitalism and the very basis on which companies thrive and deliver investor returns. Sounds a bit doomsday, doesn't it? But in a nutshell, people are concerned that through the buying of index funds, index fund providers like Vanguard will essentially own everything. As they buy shares on behalf of the clients that invest in their index funds, Vanguard could ultimately become a major shareholder in every single company in America. All our little investments into Vanguard's S&P 500 fund could lead to a position where Vanguard basically is the major shareholder of all of the biggest 500 businesses in America. What happens when Vanguard is the biggest technical owner of Microsoft and Apple, or they sit on the board of Coca-Cola and Pepsi at the same time? What is the incentive for these businesses to innovate and compete if they're all really owned by the same person? The problem is called common ownership, and between 1995 and 2015, the proportion of companies that had the same large common owners grew from 20% to 80%, according to Investopedia. Jack Bogle, who invented index funds, actually came out with a comment once that said if index funds got to a point where they were 50% of the market activity, remember at the minute they're 1/5, so a long way to go, he estimated that the big three index fund providers, which are Vanguard, BlackRock and State Street, could own as much as 30% of all of the businesses in America. Now that would be a problem.
Phenomenal cosmic power!
The problem here though isn't index funds or their increasing popularity. The problem is the concentration of ownership of those index funds across those three big players. BlackRock, Vanguard and State Street between them own 80% of all of the index fund space. It's up to the regulators and lawmakers to diversify the choice by increasing the ease of which competitors can enter the market so the ownership problem isn't too concentrated. So these big players don't become so powerful that they essentially own every single business in the world because their index funds are the only ones that are readily available to investors. But again, like in point one where we talked about the overstating of index fund influence, I think there's a little bit of that here as well. Headlines like this. Honestly, CNBC, that headline is a bit much. Putting headlines out there like that state that index funds now control 50% of the market is like saying Ben & Jerry's control 50% of the freezer space in Tesco's, when in reality what you mean is Ben & Jerry's actually control 50% of the freezer space in Tesco's that's allocated towards ice creams.
What?
It's a complete over-exaggeration or manipulation of the facts in order to get a scandalous headline. Index, ETF and also actively managed funds make up about 2/5 of all of the activity in the US stock market. Yes, that's a lot, but it's certainly not half just to index funds. And there's still 3/5 of the whole stock market activity left there that's taken up by all manner of different investors, big and small. Yes, the rise in index funds has been monumental, from currently sitting at 17.2% of the US listed companies, up from 3.5% in 2000. But a lot of those gains have come at the expense of the actively managed fund side. Yes, actively managed funds still control 1/5 of the market, but the rise in index funds basically has just been sucking money out of actively managed funds into index funds. Index fund bubbles, index fund collapse, and the problems with index funds are all catchy headlines that will win your click. Look, I do think the concerns about both index funds and the providers who provide them becoming too big are legitimate and need to be monitored, both from a regulatory standpoint and from us as investors. Just keep an eye on it year on year to make sure this index fund bubble, as people call it, doesn't get too massive. But as Jim Cramer points out here,
but something changed. Something changed this year. We got flooded with new, younger buyers who follow companies, not indices, and they are having a major impact.
Trends seem to be from the influx of new investors that have come to the market, and honestly, there is a lot of them, that they actually prefer buying individual companies as well as index funds, but not just stockpiling everything into index funds like people in the past did. So maybe the growth of indexes will slow or even decline going forwards. For now, we don't know, but I will keep an eye on it. All of this considered though, for now it won't stop me from pursuing a long-term investing strategy with index funds as part of my portfolio. I'll also be buying individual companies at the same time as well. All investment strategies are flawed. All of them have issues. You can pick any individual investment strategy and there's someone online that will tell you why doing that will cause the end of the world. So don't let misleading stats and sensational headlines convince you that the world is now owned by index fund providers and we're all about to be replaced by passively investing robots. For all we know, these rumours are being spread by the boys at the actively managed funds who've just lost all their customers.
It's going off!
I don't really need that sick go. I don't really need that just sick go. I don't really need that sick go. I don't really